top 5 dividend stocks.
Number 5 on my list. So thank you, audience, for having it. We are going to do a very quick firing round, lightning round, whatever you want to call it, on some of the highest paying and good yielding dividend stocks. Now, to just give you guys just some background, the yield on the S&P 500 stocks is at almost a record low 2%. Nah.
Not even over inflation.
Not close. Not close, guys. We've got stuff as good as in the teens for percentages. But you gotta wait and see. So we're gonna go over, guys, ladies and gentlemen, guys and girls, we're gonna go over about 5 stocks. Top 5. Number 5 on my list. Chevron. We're going in at 4% yield. Chevron has traditionally paid a very good dividend over the last 10 years or more. And the last 5 years, the stock is up 70%, along with getting a strong 4% yield. And if you go back to some of our past videos, you'll see that oil has been a good hedge during the war, which is now heating back up again. It's an on again, off again war. So you've got the hedge. You've got 2 things, 4% dividend and a great hedge and a great company that I don't think.
Yeah, been around forever. They're probably going to be around forever. Well, at least a long time.
Chevron's a little bit different in the fact that I believe they have less international exposure.
Okay, more domestic. Okay.
More international.
Safer, less exposure, less risk.
Yeah. So less risk. So I don't know. I mean, I don't want to own both because I don't want to own a poker hand of like 2 aces in the same suit. I think if somebody wanted to go into oil now, it wouldn't be terrible. I do think the time to get into that was probably about 6 months ago. But we're talking about dividend stocks, so 4% right there. The second one, which is one of my monster stocks, and we have is India Fund IFN at a whopping 18%
for a long time
yield for years since the 90s. Right,
we've talked about it for a while. I mean, the price has gone down a bit, but overall,
price has gone down. But you do the math, folks. You keep that for 5 years. You got your cash in the bank. You got the India Fund 18% yield. You will not find a stock paying that high of a yield between in the range of 12 to 20. Well, not 20, but 12 to 19% ish in that time, fluctuating with that type of a yield. You're almost bulletproof after 5 years. Amazing stock. Keep in mind that is foreign. You do have to pay foreign taxes on it. But go ahead, Dylan.
Yeah, I'm just saying the way they do it is that they're like we covered in our video, but I'll just cover briefly, is you have all this growth in the economy and they're just selling off to pay that dividend, generating it by selling off positions that are doing, because the India market's been doing really well over the last few decades. So they're very sustainable. Very sustainable.
Very sustainable. So you're getting the cash. You're getting the cash back. Not as much appreciation, of course, but extremely, extremely good if you are looking for yield. The number 3, and this is something that I don't own, but I don't think there's going to be incredible growth. I think this is the least amount of growth, but decent amount of safety, is Pfizer at a 7.1% yield. Not bad at all.
Shabby for a decent company.
Not too shabby. Not a bad company. Huge company with the drug manufacturers. I don't know exactly what they have in the pipeline, but I don't own it. But I don't own it, so I don't have a ton of information on this. But I do feel if you don't want to look at the stock and you just need income, it's very rare to get 7% in anything right now. I doubt that Pfizer is going to go out of business anytime.
Yeah, or cut their dividend, more likely. Yeah, I mean, they typically will buy biotechs that are up and coming and generate their revenue off of that. So right now they're sort of hated right now, but they have plenty of money and they can buy they have plenty of reputation. They can raise money in stocks and buy the next big drug or whatever, and then be the next amazing stock next year. That's always a very likely possibility.
Yes, and the other stock, which I do own and which actually got a decent amount of views when I bought it, I bought Jerash Holdings, which is a clothing manufacturer company, Chinese in Jordan, we talked about. And that stock pretty much popped. I think I bought it in the $3.20 range. And after strong earnings, it is now up to $4.56, up about 40% in the last 6 months, which isn't too bad.
What price did you get? Like the low threes?
Yeah, the low threes. I think 320-ish.
Okay. Yeah, not bad. Well, 50% would be what, 160 on top of that. So that'd be 480, I guess, would
Yeah,
be
it
4%,
hit a
right?
peak of
50%.
it hit a peak at 490 at June 29th and it's cooled off now at 456 right
Not
now.
bad. Yeah, 40% ish. That's not bad. Not
Plus,
bad at all.
you're getting the dividend, and the dividend yield was a lot
Oh,
higher
yeah, good
before.
point.
Dividend yield was a lot higher before, obviously. I think when I discussed the video, go back to
It
the
was close to
video.
10, wasn't it? Yeah,
Oh,
exactly.
yeah, go back to the video, folks. I kind of said I told you so. That's a proof right there. J-Rash, we made the video on it, and that's one of our popular videos. Not a bad stock. I don't think you get burned buying it right now, but fresh money in that, I think you after 40% kind of hop up, I think you've got better opportunities.
This is a good one. PennyMac Mortgage Investment Trust, PMT is the ticker, and that one is yielding a whopping 16%. A US traded mortgage. Now, obviously, it's in the housing industry, which has been slowing down, sort of a hated crappy industry. Actually, funny enough, this company was the company that bought my mortgage. So they own my house. So I'm gonna buy this stock just to own the guys that own. No, I'm just kidding. No, but they're yielding 6%. Now they are a little ahead of their skis in terms of their dividend yield being a little, dividend yield being over 100%. So they are likely, and this is a housing turnaround, likely to cut the discount, but to cut the dividend. But even then, their dividend yield is so crazy, and they're long-term company, and they've been around for a while and all that jazz. And then honorary mention is loan, although we said it was going to be 5 stocks. Honorary mention loan, 10% yield, or maybe a little under right now because the stock's bumped up a little bit. But loan is always a good go-to. Should have bought when when I recommended it at the low fours.
What's it now doing?
450-ish.
Okay, not bad.
Yeah, not as good as your Jirash, but my whole time has been shorter than your Jirash, right? You recommended
Yeah,
it
Jirash, I think
ago?
February. I think it was
Longer
February.
than 4 months ago, I guess, huh?
Yeah,
'Cause
February, March, April, May, June, July.
5 months
Yeah,
ago.
yeah,
Yeah.
4 or 5 months ago. Yeah,
Do they? When you pay the dividends, does the country take a little bit off the top? Out of curiosity,
they do because it's foreign.
how much? 25%?
Yeah, roughly.
Okay, there's not like a set amount.
No.
Oh, okay. Yeah, because I know I bought a Canadian REIT and I got that 25%, and I was like, I'm dumping this. This is garbage. I'm gonna gypped. When you get a little piece of my money. Yeah, that's what I'm recommending now. And there's other ones too, but that's just a killer yield for something that's a pretty decent but beaten down company. So PMT is a ticker, PennyMac Mortgage Investment Trust. Got top 5.
Top 5. So let's get into just talking about dividend stocks and why to own them, who should own them, if we own them.
That's a good point. Yes,
Go ahead.
absolutely.
Okay, I'll go first since I can kind of pose the question. I don't want to put you on the spot. So, who should own dividend stocks? People who obviously need income. You know what I mean? If you need income and it's a good way to get yield and you need to pay bills or do anything and aren't caring about appreciation, dividend stocks can come into play. So, who is that? So, who needs mostly income? Are older folks, right? Maybe you're retired, not working, just on Social Security. Your life expectancy isn't going to be crazy high once you turn in your 70s, unless you want to hit 100, which I know Dylan wants to, and I want to.
100 plus.
Yeah, 100 plus. But at 100 plus, a lot of people don't want to be working a full-time job, doing whatever they do at 80, 90, and they want to rest off and rest on their laurels. So that's part of it. So people want that. Other people are dividend stocks assuming they have a long track record, right, tend to have better financial management. Why? Because every quarter they need enough cash flow to pay out their shareholders. So it shows some restraint in crazy cash flows. Does not always, but it comes with some risk, right? Because as soon as a stock cuts a dividend, boy, does that stock take a big hit. Normally a lot more than dividend.
Oh yeah.
Well, do you have any examples, Dylan? Or there's so many. Like what was it? Whirlpool. Oh my God! Once they cut their dividend,
That's a good one. Yeah.
you remember 20, 30% in a day. So if a company's having a bad thing, you got to get out of that before they cut the dividend. I have a story. I owned a big time stock. This is actually one of the first stocks I've ever owned. Not the first stock, but maybe one of the fifth stock. It was called Seadrill, SDRL. And it was an offshore drilling company that was paying like a 12% yield. Problem is that they were in just absolute incredible debt. And one of my good friends told me, Chris, you better get out of that stock, because it's not going to be sustainable. I got out of it. stock went down to zero. So sometimes when you have too high of a yield, you throw the red flag. You throw a red flag.
Dividend trap.
Could be a dividend trap.
Yeah, so that I will say that, like Chris was saying, not only for older people, like people that are planning on living off their investments. So like once you hit like 500K, at least in the U.S., 500K, a million, 2 million, whatever your number is, depending on your lifestyle, you can start to switch over your portfolio to dividend stocks or bonds or whatever your strategy is, where you're freeing up your time to have instead of having a daily job or like a time where you need to spend your 40 hours. Now you get that income, and that just replaces. Now you have more free time to travel or sleep or whatever you want to do. Start your next company or whatever you want to do. It gives you the freedom to do it. So people that are sort of want to retire early or whatever. It's more like sort of my frame of mind where I want to get out of doing the job. That then replaces the money, so I can then pay for other stuff. And then, like Chris said, it's a good filter because we just filtered all companies in the U.S. and you filtered out everything that had been paying for a dividend for 10 plus years or 20 plus years, something like that. You'd basically be having like about 90% just solid companies, dudes that are shareholder friendly, that are going to pay you money. They've been doing it for years. It's like your friend that's your roommate. You've been roommate for 10 years. He always pays the rent a day early. He's solid. You can bet your life on that guy. Same thing with this company. Now, obviously, like this one guy, he maybe has a heart attack or whatever. Same thing with the company. There can be some freak accident, but compared to your average company, they're like 3 notches above. So it's a good filter mechanism, honestly. And one good way, especially with the company, the way the stock market. So when you buy an index fund, you're putting 30-40% of your net worth in like 5 companies. You're kind of like, okay, that wouldn't be what I recommend at this point. So another option you could do is to buy an ETF where you're just paying for stocks that are paying a dividend for the last 20 years or 10 years or something like that, and the yield is at least 3% or whatever. You're basically using a filter of like not overpriced long-term dividend, like decent companies. They make like Caterpillar or whatever, like they've been going along doing business and treating their shareholders right. That would be probably a safer bet in my mind in terms of buying as opposed to buying this S&P index fund at this point.
We're kind of more focused on growth. Dylan even more so, hyper growth.
Yes.
You know what I mean? Then I guess you call it income investors, which obviously is a play. That is an investment strategy of a lot of firms and a lot of people. They strictly want, and they normally cater to, like I say, retired people and things like that who need that dividend play, where they don't care if an Nvidia grows within 80%. They need those. You need those checks. So not to say we don't buy dividend stocks. I mean, we have. Dylan owns.
I've owned lots of dividend stocks. I own loan. Yeah, it's something that I think should be on your mind at least, because once you grow your portfolio to a certain amount, like if you have $100 million invested, are you still gonna work at McDonald's or whatever? Of course not. But then you need, unless you keep selling a certain percentage of your portfolio automatically, which you can do, but it's a little simpler to just shift it into a dividend stock and or some sort of cash flowing instrument, debt or bond or whatever, and then or even like a restaurant, like a chain, franchise, franchise like a Starbucks or whatever. You put that money there and it yields a certain percent back. Wherever you're doing, you're putting your money, and you're getting a yield on that as a passive. Like you don't for a franchise owner, it's like 10 hours, 5 to 10 hours a week. So it's fairly passive, not nearly as passive as a stockholder where you could be doing just a few hours a year, but you're just going to yield a lot more. So anyways, it should be a something to keep in mind for every investor who's even for just growth. At some point, you're probably going to want to get some cash out, and that is one of the options you should be thinking with it. So,
yeah, we went through. There are other stocks that pay dividend. I mean, Nvidia,
lots of stocks.
It pays a dividend, but we wanted to focus on this video on things with a significant yield that are yielding over the average of about, I think it's 1.8 to 2%. Although now, I guess you have to watch, because government bonds, which actually we should mention, government is paying. You know what I mean? 4% roughly. About 3, 4,
yeah, 4+. Yeah,
3 to 4. Let's just say 3.
Well, long term, it's 4+.
Yeah, but okay, you know what I'm saying. Like let's go after a year, because we're going. most stocks, year-round dividend, et cetera. They pay. So
Okay,
a
sure.
year, so like a year treasury, I think he's paying you about 3.5, 3.6%, somewhere in there. So
Yeah.
even for stocks to beat that, it's pretty challenging. I mean, Dylan and I were looking through stocks, and just some names out there that we didn't trust going out there, like Kraft and what was it, Verizon? Is that what was that?
Verizon, yeah, AT&T, just bad management, or just against the trends, or just the stock is losing so much money. You're gonna be in the red even with the crazy dividend yield.
Yeah, and that's actually one thing we should mention. I mean, if you're borrowing money to pay the dividend, that's another big no-no. In
Or
my
issue shares.
yeah, a big no-no in my thing. So you definitely don't want that happening. Or maybe paying all their free cash flow for the dividend, nothing left for themselves. Then that's another kind of look. It's not super scary, but you got to do some more detective work on see what.
Yeah, I mean, I will add something also on the dividend stock. Generally, when the company is young, just like if you started a company, me and Chris, we started the next like Starbucks competition, and we got this better idea than Starbucks. We're gonna do protein coffee, and we're gonna take over the Starbucks market, right? Just like all these guys when these companies, these Starbucks, these Costco's, whatever, and they started out, they're just three guys, and they're against the world or whatever. When they're starting out and they're just hiring people and they got money from some investors, desperately growth. They can't pay anything back to their investors for a while. So it's just all growth. It's growth. It's now the company's worth $1 million. We opened 17 new stores. We got franchises hired. Me and Chris are taking over. It's the coffee bucks. We're taking over Starbucks market, right? Starbucks is going down and we're going up, and all that money just going to be good. Buy the next lease, this, that. And once a company matures and sort of stabilizes, and let's say we're saturated, we've taken over all the Starbucks locations, and now it's Coffee Bucks has taken over. Now we can start returning money to shareholders once the company is sort of like at least semi-plateaued. Maybe we have an international or whatever, but we're sort of stable. That's sort of in terms of the life cycle before the company starts going down and then shuts down to bankruptcy. The stable phase, which can last for centuries. But most typically last for some decades. So that's growth is more like an earlier start of the earlier part of the company. Not all companies. Some companies just never will pay a dividend. Like a Google or whatever, Berkshire Hathaway.
Yeah, I was always wondering. I'm kind of going off topic here. Why? What was Buffett's reason for not ever paying a dividend? Do you know that? I did.
Yeah. He thought he could. So you have two choices as a company, right? You have all this capital. Do you give it to your shareholders, or so Warren Buffett has the best long-term track record at 27%. Can they get 27% at the bank or anywhere else? Of course not. No one's paying them 27%. So he's like, good, I'll keep the money. I'll keep growing the earnings and everything, whatever, at 27%. And then you don't need to pay any tax on the dividends. That was his whole strategy. And he even put it to a vote several times. And the shareholders did not want a dividend. They wanted to keep the money in the company because he was growing it so predictably and at a rate I mean, if they got the money, they'd be like, okay, I'm putting in the bank, I'm getting 4%, my savings are 3% on my savings account, or put in bonds, I'm getting 5% maybe. Like, it's just like, can I just leave it with you? You're making better money.
Oh, makes sense.
Yeah.
Well, that makes sense for sure.
They don't need the money. They weren't buying that because they wanted the money back. They were buying it for the maximum appreciation.
Okay. Okay, that definitely makes sense. So, okay, so what else can we say about dividend stocks, Dylan? Do you own any other dividend stocks that are worth mentioning, or any terrible dividend stocks that you know of? I mean, we kind of touched on T-Mobile, not T-Mobile, Verizon, but
Whirlpool.
what's that?
Whirlpool.
Yeah. Whirlpool.
Yeah. I mean, there's dividend traps you need to be aware of. Obviously, with the dividends or the business like Shutterstock is an example of a stock we looked at that AI is presumably just going to replace and get rid of. So that one is yielding 20%. But I'm like, I don't know how sustainable the revenues are. Like people like these thumbnails get made with AI for these videos. They don't get made in Shutterstock. I just don't. I don't know that Shutterstock is going to be around with AI generating images so easily and freely right now, freely. So it's like I don't really see a case for Shutterstock, but they have a 20% yield. But it's like how are they going to make that money? Who's going to pay for, the images that you put on your website or your whatever that you just buy? Like you type in coffee and coffee mugs and you put that on your website or your whatever, and you need an image of coffee to kind of go along with your presentation or something like that. And you pay, a subscription or whatever their model is. You pay for the image per image um, so you have to make sure the business is sustainable, like a Starbucks or whatever, like the businesses we talked about, Jerash, they make stuff for Nike and all that sort of stuff. That's probably not going anywhere. Uh, that big pharma you talked about, they buy drugs from new biotech and they commercialize them. That's what they do. They get them, advertisements for them, and they grow the revenue. They get it international. That's their business model. That's not going anywhere. There's lots of better drugs to be made and sold and everything. So you have to make sure the business model makes sense. It's sustainable. The dividend yield, they've been managing well, this sort of thing. So another thing I can mention on that subject is trading around dividends, where typically you have a dividend drop after the company issues the dividend, which is roughly proportional to the amount the dividend is issued.
Ex-dividend date. Yeah, go ahead.
Ex-dividend date, exactly. So the ex-dividend date is 11th of September, let's just say, and they usually pay 40 cents a quarter. This $20 stock. It's going to go from $20 to $19.60 roughly. It depends exactly. It doesn't do exactly, but it's typically going to go down, and this because the market's basically going to price in, if you bought it here and then you sold it there, you can't just make that 40 cents. It's not free money. You have to go out with your roughly 40-cent drop. The market's going to wiggle at that 40%, but you're going to have a little bit market risk. Maybe it's a little below 40 if you're just catching that dividend. So you can go in and out, or some people will buy it, it'll dip down, and then it'll recover over time, and then they sell it, a month later or whatever. And that's a strategy I've tried as well, and it's another way to make money on that, and it's sort of okay, but there's more money made elsewhere. But that's a strategy you can do to make money.
Yeah, absolutely. And
Trade dividend stocks.
Yeah, ex-dividend date. If you have a specific percentage, it goes down, right? And well, I guess we should say that. Some stocks pay dividends quarterly. Most of them pay quarterly, but some pay monthly. Some stocks do.
A few, yeah. Generally, they're a little sketchy in my opinion if they pay monthly, and then foreign typically pay yearly.
Yeah, exactly. So you have different. That's another thing I guess we should mention. You have different payouts for dividends, dividend stocks.
And like we talked about earlier, sometimes the foreign companies, the government will take off a tax or whatever, so to speak, off the top before you even get that 10% yield or whatever it is. They just a typical government. They try to take the money before it goes in your pocket.
Yeah. So watch out for a lot of, especially foreign stocks, etc. You're probably gonna get some money taken out. You know what I mean? Well, could be 20% or whatever.
Canada is dirty Canadians. There was 25%.
Yeah. So you definitely have to factor that into your play, assuming you are in the U.S. and assuming you are trading in the U.S. market, because I imagine we've got international viewers here, so it's different. It's different. So I guess the one thing I have to say is definitely do your homework with your dividend plays, and especially if they're international for sure. Dylan, what else? Is there anything else you want to say? Final word on dividends that we haven't touched on? We've touched on high yields. We've touched on crappy dividends. We've touched on dividend dates. We've touched on why we don't go strictly just into dividend stocks. Is there anything else you think the audience is going to want to hear?
I think it's it in a video of this size. There's obviously a lot to dig into in terms of how, REITs where 90% of their income it has to be dividends. There's a lot more to talk about in dividends, but for a video of this nature, I think we've covered, a lot of the basics. If you're buying a stock for the dividend, look at the track record. Like the main thing is look at the track record, look at the business sustainable. Is the share price gonna go down below your, like it has a 10% dividend, but for the stock goes down 20% every year for the last 10 years, then it's not the best stock to buy, obviously, unless you see some turnaround coming, but that's pretty unlikely. So you want to make sure that the all these stocks we brought up, Jerash has gone up, Chevron will go up, I'm sure, with the gas prices, and these other companies are the housing market has beaten up the PennyMac, but the housing market's going to turn around at some point next year, 10 years, whatever it's going to be, and that stock will revalue accordingly. So at loan as well, with the coming mayor ends, the stock will be repriced in the sixes, I'm sure. Or if they grow in Florida, they'll go even higher.
Perfect, perfect. We got exactly 1 minute left. So I think on next week, I wouldn't mind talking about the politics a little bit to see if maybe the midterms could factor into the market or not, or we'll figure out something out. We can talk about next week. Maybe perhaps we can put it up.
That's a good one yeah. You're a lot more involved in politics, especially with your new job, your side hustle. So yeah, let's sounds like a good topic. Let's see, is that going to affect the market? How might it? Let's throw it all out like the tariff tantrums and see if we can make any money on this upcoming event that may or may not affect the markets.
Absolutely, absolutely. And I will say goodbye to the audience.